Fears continue to rise with no clear end to the war in Iran. But our next guest says history shows geopolitical shocks rarely knock equity markets off course for long. Brian Belski joins us now, CEO and CIO of Cumulus Investment Strategies. Thanks for joining us today.
Thanks for having us, Morella. Good afternoon, Canada.
So there are comparisons to what happened in the 1970s and the oil crisis then, but you say things are different now. Can you explain?
Yeah, anytime you say it's different this time, that's usually the kiss of death, quote unquote. But the variables with respect to fundamentals are very, very different with respect to energy. Let's kind of take two steps back, and here's the reality. The United States of America is the world's largest producer of oil. And it wasn't that way in the 1970s, and the embargo actually had that forced double dip recession in the 1970s. We were much more reliant on what was happening in the Middle East. And then, of course, we had the Iran terrorist activity in 1979 into 1980 that really drove the United States into that almost second dip recession. And so we're in a much different base of support here. That's number one. Number two, I don't know if it's a war yet. I think that's a little bit too aggressive. I think there's an issue there that had to be taken care of with respect to not only national security but also the security of the rest of the world. And I do think that at the end of the day, what we're seeing there is going to happen and going to unfold probably a lot faster than everybody thinks. You know, it's really interesting, Morella, about politics is that in geopolitical events, it's really difficult to invest around them. I remember my very first year being paid to do this job was 1990. And my boss at the time was William O'Neill. And in August of 1990, he brought the entire company together on one floor. And he said, I think we're heading into a recession. That's when Iraq invaded Kuwait. Market was down 8% for the first 3 months. And then a year later, the stock market was up 10.2%. And so I think it's really difficult to time these things. We do believe that this is not a full-blown war. We think this is a situation that we believe will be over a lot faster than everybody else thinks.
Okay, so let's talk a little bit about where do you think the price of oil, which has been hovering, depending on where you're looking, in the mid-90s or over, where do you think it'll land after the conflict?
Well, you think we start to see demand destruction, quite frankly, above $100 for a duration. Duration means a period of time. So we think it's 3 to 6 months minimum to be above $100 to see the type of demand destruction that most people are worried about in terms of recession. We think, given the fact of supply is very strong, the strategic petroleum reserve is being rebuilt. We have the issue with respect to U.S. energy in general, and the strait is open. And so at the end of the day, we think that we're going to hover back down in the 60 to 70 region, at least to start. And remember, too, that supply in terms of oil has been increasing for the last couple of years. So we think this is a shock, and investors should not be reacting to it accordingly.
Okay, so many experts that we have spoken to here say it is the fallout that could be the big deal because some of the production is now offline in the Middle East, plus you've got the backup in the Strait, plus energy reserves are already being tapped. Are you factoring that into your projections?
100%. Of course we have to. And remember, it's been a month. And again, too, a month doesn't shut things down. They can crank that right back up again. And if you think about the supply that can come out of there much more freely once ships are feeling safe about providing oil in and out of the Strait, I think that's going to be really important. Plus, remember, too, you got the pipeline coming out of there as well. So I do think that people, once again, are focusing on the negative. Canada tends to be a much more macro-dominated, especially the energy side of things, and default to the economic point of view. I think from a fundamental perspective, there's a reason, Morella, there's a reason that U.S. stocks have dramatically outperformed the rest of the world during this conflict. And it's because from a fundamental perspective, we're much better positioned longer term. If there is a prolonged 3 to 6 month time frame, which is not our base case, but if there is, that's why U.S. stocks have actually outperformed during this entire time.
Okay, let's get to some of your stock picks during this time. Costco is one. I've heard others raise concerns about valuation. Does that bother you?
Others, I know others are negative. Costco is the top 25 company in the world. Costco should be part of every North American portfolio in terms of large cap and core. Here's why. It fits a fantastic theme in terms of consumer staples. Their business model is amazing. They make so much money off their memberships. Plus, we're all sitting in line with our cars trying to buy cheaper gas relative to what's at the gas station. And so that trend continues. And plus, with respect to what they're doing in food and just overall merchandising, we think Costco's a top 25 company in the world.
Okay, let's get to your next pick. Shopify. What are you liking about Shopify right now?
Shopify, I think, has been unjustly kind of baby in the bathwater in terms of some of the technology stocks, Marilla. We think that Shopify is the portal for small mid-cap companies in North America. And we do believe that if and when we see a broader unwind in private credit, private equity, those assets are going into small mid-cap companies. And that should only further solidify the business model and the business volumes that we're seeing that coming into Shopify. So Shopify, we believe, is a top 10 tech holding in North America.
Interesting. Okay, I do have to leave it there, Brian. Unfortunately, I'm out of time, but thanks for your time. Appreciate it.